Most people spend their lives working for money. But what if your money could work for you? The average self-made millionaire invests at least 20% of their income every year. It's not about a huge salary. It's about making your money work relentlessly in the background, compounding over time. This is the real secret to building lasting wealth. In this video, we'll reveal 5 proven strategies to invest for long-term wealth, no matter how little you start with. Welcome to the Power to Succeed series, your go-to channel for smart money moves and financial independence. Investing isn't just for the ultra-rich. With the right tools and knowledge, anyone can build a secure financial future. Today, I'll break down simple, actionable investment strategies that turn small, consistent contributions into real wealth. Let's dive in. Let's start with the single best entry point for most new investors: index funds and ETFs. Don't let the jargon scare you. The idea is simple and powerful. Instead of picking individual stocks, you buy a tiny piece of everything in a market index like the S&P 500. That means you own a slice of 500 of America's biggest companies: Apple, Microsoft, Amazon, and more. This gives you instant diversification. If one company struggles, the others help balance it out. Index funds and ETFs are also incredibly low cost. Active fund managers charge high fees, but index funds just mirror the market, so their fees are tiny. Over decades, those savings add up to thousands more in your pocket. Historically, the S&P 500 has returned about 10% per year on average. That's the power of the entire US economy working for you. For example, if you invested $1,000 in an S&P 500 index fund in 1990 and left it alone, by 2020, it would have grown to over $23,000. That's compound growth. Your money working harder every year. Index funds take the guesswork and emotion out of investing. You don't need to research companies or stress about market swings. Just buy the whole market, hold for the long term, and let time do the work. Even Warren Buffett recommends a low-cost S&P 500 index fund for most people. ETFs work similarly, but trade like stocks, so you can buy and sell them throughout the day. There are ETFs for almost any market: US, global, even specific sectors. With modern apps, you can start investing with just a few dollars, even buying fractional shares. The barrier to entry has never been lower. To recap, focus on low-cost, broad market index funds or ETFs. They offer diversification, strong long-term returns, and simplicity. Remember, the market goes up and down in the short term. The key is to stay invested and see downturns as opportunities, not reasons to panic. This is a marathon, not a sprint. Start small, stay consistent, and let your money grow. Don't try to time the market. Just keep investing. Over time, you'll build a solid foundation for wealth. The earlier you start, the more powerful compounding becomes. Even if you can only invest a little, it adds up. Make it automatic, and you'll barely notice the money leaving your account. The best time to start was yesterday. The second best time is now. Don't wait for the perfect moment, just begin. Your future self will thank you. Let's move on to the next strategy. Next up, dividend stocks. A way to get paid just for owning investments. A dividend is a portion of a company's profits paid out to shareholders, often every quarter. Many large, stable companies, called blue chips, pay dividends, creating a steady stream of passive income. For example, if you own 100 shares of a company that pays $2 per share annually, you get $200 a year. No extra work required. The real magic happens when you reinvest those dividends. Most brokerages let you automatically buy more shares with your payouts, creating a compounding snowball effect. Each year, your dividend income and your ownership grow, all without adding new money. Look for companies with a long history of paying and increasing dividends. These are called dividend aristocrats or dividend kings. Key metrics: dividend yield, the percentage return from dividends, and payout ratio, how much of profits go to dividends. A healthy payout ratio means the company can keep paying, even in tough times. If picking individual stocks feels overwhelming, there are dividend-focused ETFs that hold dozens or hundreds of dividend-paying companies for instant diversification. Popular options include the Schwab US Dividend Equity ETF and the Vanguard Dividend Appreciation ETF. The psychological benefit is huge. Even when markets drop, you're still getting paid, which helps you stay invested. Dividend investing is a powerful way to generate passive income and build wealth over time. Focus on quality companies, reinvest your dividends, and let compounding do the heavy lifting. Whether you pick individual stocks or use a dividend ETF, this strategy adds another layer of return to your portfolio. It's especially valuable as you approach retirement, providing a steady income stream. Remember, patience and consistency are key. Don't chase the highest yields. Look for reliability and growth. Over time, your dividend snowball can become a major source of wealth. Start small, reinvest, and watch your income grow. Even a modest portfolio can generate meaningful cash flow. Combine dividends with other strategies for a balanced approach. The earlier you start, the more powerful the compounding effect. Let your money work for you, not the other way around. Passive income is the ultimate financial freedom. Ready for the next strategy? Let's go! On to real estate, without the headaches. Real estate is a classic wealth builder, but owning property is expensive and time-consuming. Enter REITs, real estate investment trusts. These companies own or finance income-producing real estate, from apartments to data centers. When you buy a REIT, you own a piece of a huge property portfolio, and by law, REITs must pay out at least 90% of their income as dividends. That means higher payouts than most stocks, and you don't have to be a landlord. REITs are traded on stock exchanges, so you can buy and sell them easily, just like stocks. With a few dollars, you get exposure to hundreds of properties and instant diversification. Even top investors like Warren Buffett use REITs for real estate exposure. There are different types. Equity REITs own properties, mortgage REITs finance them. For most beginners, equity REITs are simpler and safer. You can buy individual REITs or REIT ETFs like Vanguard's V&Q for broad exposure. REITs combine the income and growth potential of real estate with the liquidity and low entry cost of the stock market. No tenants, no repairs, just passive income and diversification. If you want real estate in your portfolio without the hassle, REITs are your answer. They democratize real estate investing for everyone. Add REITs for another stream of income and valuable diversification. Now let's talk about how to invest, not just what to invest in. Dollar cost averaging, or DCA, is a simple way to reduce risk and build wealth automatically. You invest a fixed amount at regular intervals, say $100 every month, no matter what the market is doing. This takes emotion out of investing. You buy more shares when prices are low, fewer when they're high, lowering your average cost over time. Trying to time the market rarely works. DCA keeps you disciplined and consistent. For example, investing $200 a month in an S&P 500 fund for 20 years could turn $48,000 into over $100,000, thanks to compounding and steady contributions. Automate your investments so you never forget or hesitate. DCA is perfect if you don't have a lump sum, just use your regular income. It turns investing into a habit, like paying a bill. When markets drop, your plan keeps buying at a discount. When markets soar, you avoid over-investing at the top. DCA doesn't guarantee profits, but it helps you avoid big mistakes and stay on track. Combine DCA with diversified investments like index funds for best results. Think of each regular investment as a brick in your wall of wealth. Over time, those bricks add up to something massive. Decide on an amount, automate it, and let your wealth grow in the background. The key is consistency, not perfection. Don't let fear or greed derail your plan. Set it, forget it, and watch your future take shape. Now let's talk about the foundation every investor needs. Before you invest, you need an emergency fund, your financial safety net. This is cash in a high-yield savings account, reserved for true emergencies like job loss or medical bills. Aim for 3-6 months of essential expenses. Figure out your bare minimum monthly needs and multiply by 3 to 6. Without this buffer, you might be forced to sell investments at the worst possible time. An emergency fund lets you handle life's surprises without derailing your long-term plan. It also gives you peace of mind so you can invest confidently. I call it the Emergency and Opportunity Fund. Why? Because in a market crash, having cash on hand lets you buy assets on sale. Don't drain your emergency fund for investments, but if you've built a larger cushion, you can seize rare opportunities. Keep your fund in a high-yield FDIC-insured account so it keeps up with inflation and is always accessible. Building this fund should be your first financial priority. It's not as exciting as investing, but it's the bedrock of a strong financial life. Once you have your safety net, you can invest for the long term with confidence. Don't skip this step, it's the foundation of wealth. Protect yourself first, then build your future. Now let's wrap up your journey to wealth. There you have it. 5 proven strategies to start building long-term wealth. We covered index funds, dividend stocks, REITs, dollar cost averaging, and the emergency fund. The goal isn't to become a stock market genius overnight, but to build simple, sustainable habits that let your money work for you. Which strategy excites you most? Let us know in the comments. Sharing your plans helps you commit and inspires others. If you found value, hit like and subscribe. Next week, we'll reveal 5 passive income ideas you can start with zero money. Building wealth is a marathon, not a sprint. And we'll be here with you every step of the way. Thanks for watching. See you in the next one.